Hey everyone, and welcome. Today we're going to tackle one of the most famous numbers in the investing world, the price to earnings ratio. We're going to break down what it is, how it works, and what it really means for you.
So you're looking at a stock, right? And this is the question that's always in the back of your mind. You see that price jumping all over the place, and you just have to wonder, is this thing a bargain or is it way too expensive? How can you even tell?
To get to the bottom of that, here's how we're going to break it all down. We'll start with that big overvalued question. Then we'll really decode what the PE ratio is all about. After that, we'll talk about context, which is key. We'll look at past versus future numbers and wrap up by seeing this thing for what it is, a tool, not a magic rule.
You know, stock prices can feel totally random sometimes. They jump on news, they drop on rumors, it's a lot of noise. And that's exactly why investors need a way to cut through all that chaos and make decisions with confidence.
And that's where our hero for today comes in. We're going to get to know one of the most fundamental tools out there for figuring out if a stock's price tag actually makes sense. And that tool is the PE ratio.
All right, so let's get into it. What exactly is this PE ratio? We're going to decode the formula and figure out what it's really telling us. And don't worry, I promise, it's way simpler than it sounds.
So, the official definition is that the price-to-earnings ratio is a valuation tool that compares a company's share price to its earnings. But what does that really mean? Well, at its heart, it's just a simple comparison. It's what the market is willing to pay for a stock today versus how much profit that company is actually making.
And the formula? It could not be simpler. All you do is take the current stock price and divide it by the company's earnings per share, or EPS for short.
Okay, but what's this EPS thing, earnings per share? Well, just think about it like this. If a company took every last dollar of its profit and split it up evenly among all its stock shares, the EPS is what one single share's slice of the pie would be. It's basically the company's profitability broken down to a per-share level.
Let's put some real numbers on this to make it stick. Let's say a stock is trading for $100 a share, and the company earns $10 per share. You just do the math, 100 divided by 10, and voila, you've got a PE ratio of 10. See? Easy.
So what on earth does that 10 actually mean? It's not just a random number. A PE of 10 tells you that for every single dollar of profit the company makes, investors are currently willing to pay $10 to own a piece of that profit. This is the big insight the PE ratio gives you. Okay, so we've got our number, but a PE of 10 or 20 or 50, it means absolutely nothing in a vacuum. The real magic happens when you put that number into context. So let's figure out how to do that.
So generally speaking, a really high PE ratio signals that investors have super high expectations. They're happy to pay a lot today because they're betting that the company's profits are about to go to the moon. On the flip side, a low PE could mean you found a hidden gem, a stock that's on sale, or it could be a warning sign that the company is facing some serious headwinds.
And this is why you absolutely cannot compare apples to oranges. A hot tech company might have a PE of 50, or even higher, because everyone's betting on huge growth. But a steady, stable utility company will have a much lower one. The golden rule is you always have to compare companies within the same industry. Okay, check out this example. We've got two companies, Fresh Bite and Tasty Treats. They're in the same business, and look, they have the exact same earnings per share. But Tasty Treats has a higher PE. Why is that? Well, the market thinks it's going to grow faster. Now, if the industry average PE is 12, Fresh Bite's PE of 10 looks pretty attractive, maybe even undervalued. Meanwhile, Tasty Treats, at 15, looks a bit pricey, unless that growth really happens. All right, let's add one more important layer here. Not all PE ratios are looking at the same thing. Some are looking at the past, and some are trying to predict the future.
And this is a really big deal. You've got the trailing PE, which uses the actual real-deal earnings from the last year. It's based on facts. Then you have the forward PE, which is based on what analysts think the company will earn in the next year. It's an educated guess. And, well, guesses can be wrong.
Let's see how this plays out with our example, Brightech Solar. Based on what they actually earned last year, its trailing PE is 20. But analysts are super optimistic. They think earnings are going to double. So that cuts the forward PE all the way down to 10. When you see a forward PE that's lower than the trailing PE, it's a clear signal that the experts are expecting big growth.
And you know, it works the other way too. If you saw forward PE that was higher than the trailing PE, that's a bit of a red flag. It means analysts are predicting that profits are actually going to shrink over the next year.
So by now, you can see how useful this little ratio is. But, and this is a big but, it is not a crystal ball. It's just a tool. And like any tool, it's got its pros and its cons.
Let's start with the good news. What's so great about the PE ratio? Well, for one, it's super easy to calculate and understand. It gives you a really quick snapshot of what the market is thinking. And it's fantastic for comparing similar companies head to head.
But here's the catch. The PE ratio is only one piece of a much bigger puzzle. It doesn't tell you anything about a company's debt or how much cash it has in the bank. And it can get totally thrown off by a weird one-time event in the earnings report. It has a laser focus on price and profit, and it ignores a lot of other really important stuff.
This quote really just sums it all up perfectly. A low PE doesn't automatically mean buy, and a high PE doesn't automatically mean sell. The number itself isn't the answer. The number is the start of a question, and that question is why? Why is the PE what it is? That's where your real detective work begins.
Because at the end of the day, the PE ratio is just one single tool in a whole toolbox full of them. And trying to make all your investment decisions based only on the PE ratio, that's kind of like trying to build a house with nothing but a hammer. You're going to miss a lot.
So, the big takeaway here is this. The PE ratio is a fantastic lens for looking at a stock's price, but it only shows you one part of the story. And that leaves us with a really important final thought to chew on. If the PE ratio is all about earnings, what other things do we need to be looking at to see the entire picture?